Let me ask you a simple question. If you invest 5,000 rupees today, in exactly 5 years, will you have 30,000 rupees, 80,000 rupees, or maybe just 12,000 rupees? You are investing the exact same amount of money for the exact same amount of time, but the end result is wildly different. That gap comes down to a single decision you make right at the start. This is where most people get tripped up. You hear terms like equity, debt, and hybrid thrown around, and it's easy to assume that a mutual fund is just one single magic ticket to making money. Think of a mutual fund as a basket at a large food buffet. If you walk up and pile your plate with the spiciest item on the table without knowing what it is, you are going to walk away with a severe stomachache. When new investors lose money and complain that the financial system is broken, the system usually worked fine. They simply chose the completely wrong meal for their specific appetite. Let's actually look at what is sitting on that buffet table, starting with the highest energy option available. Equity funds put your money directly into the stock market and growing startup companies. In our buffet analogy, this is the spicy, high-growth meal. This chart shows an equity fund's exact trade-off. You get rocket-like growth, but must survive terrifying drops when the market crashes. Due to this turbulence, you must look at the timelines far right. Wait 5 to 10 years, and equity becomes an incredible wealth engine. On the exact opposite side of the table, we have debt funds. This is the staple, comforting food of the financial world. Instead of buying pieces of companies, you are essentially loaning your money to the government or large, stable corporations. They pay you back with a steady, predictable stream of interest. There are no sudden market crashes here. A calm, low-risk flow of returns. Equity brings the aggressive growth, while debt brings the required safety. But leaning entirely on just one of these extremes is rarely a good idea if you are just starting out. This brings us to hybrid funds. Think of this as a mixed thali that mathematically blends both the spicy equity and the comforting debt into one prepackaged plate. It is built specifically for people who want to see their money grow, but know they couldn't stomach the sudden heart attacks of a pure stock market crash. But 90% of beginners walk right into a trap here. They assume the word hybrid means their money is completely immune to market risk. It isn't. The risk is reduced, not eliminated. That leads us to the single most important option on the menu, one that beginners almost always ignore: index funds. This animated chart illustrates the entire strategy of an index fund. Instead of paying an expert to guess which companies will win, an index fund simply copies the average performance of the top 50 companies, like the Nifty 50. It makes the exact same movements as the broader economy. By copying rather than guessing, the fees stay incredibly low, and over a long timeline, those erratic lines, the expensive professional investors trying to beat the market, almost always fall behind the simple, lazy index. In investing, trying to outsmart everyone else usually loses to simple consistency. Take Rati, for example. He's a 28-year-old software engineer. Over 5 years, his portfolio grew 2 to 3 times faster than his coworkers, even though they all take home the exact same salary. This pie chart maps out Ravi's monthly automatic investment diet. He uses an index fund as his large, stable foundation. He adds a medium slice of pure equity for aggressive growth and finishes with a small slice of debt to keep things secure. His coworkers made the classic mistakes. They chased whatever fund had the highest return last month, they pulled their money out after a single year, and they completely ignored their own tolerance for risk. If you are starting out today, you can replicate this right now. Set up an automatic monthly transfer into one index fund and one equity fund. You can start this with as little as 500 rupees. But there is one absolute requirement. Once that system is running, you cannot touch that money for at least 5 years. The real advantage comes from choosing a clear strategy and sticking to it, rather than spending your energy hunting for a single magical fund. Mutual funds are a mechanical system. You just need to balance your plate. Once you do that, you are already ahead of 90% of the people out there.